In this video, we will be taking a closer look at Roper Technologies' dividend safety. Let's first start by talking about Roper Technologies' business model. Roper Technologies is a diversified technology company. The company was founded in 1981, and since then, the company has grown into a global organization that produces and sells engineered products to several niche markets, including medical imaging, RF technologies, and energy systems. Roper Technologies has 14,000 employees, trades with a market capitalization of $33 billion, and generates annual revenues of more than $5 billion. Roper Technologies is a well-known dividend stock because of its compelling track record of dividend growth, with 26 years of consecutive dividend increases. Roper Technologies qualifies to be a dividend aristocrat, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. Roper Technologies offers a dividend yield of 0.6% at current prices, which is well below the broad market's yield. The very low current dividend yield already is a sign of a quite safe dividend. With that said, investors should always take a close look at a company's dividend safety beyond assessing its current yield. In this video, we will discuss the company's current dividend safety from four perspectives. 1. Its dividend safety in the context of its current earnings. 2. Its dividend safety in the context of its current free cash flow. 3. Its dividend safety in the context of its recession performance. 4. Its dividend safety in the context of its current debt load. First, let's discuss Roper Technologies' dividend safety relative to the company's current earnings. Roper Technologies announced its fourth quarter and full-year earnings results on February 2nd. The company reported that it had generated earnings per share of $11.81 during the most recent 4 quarters. Roper Technologies pays out $1.85 in dividends and per-share dividends each year, which means that Roper Technologies' current dividend payout ratio is 15.6%. Overall, Roper Technologies' dividend looks extremely safe relative to the net profits that the company generates. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Roper Technologies' current dividend payment to its free cash flow. During fiscal 2018, Roper Technologies generated operating cash flows of $1.43 billion. With capital expenditures totaling just $49 million during fiscal 2018, Roper Technologies generated free cash flows of $1.38 billion during the last fiscal year. The company distributed $170 million of common share dividends last year for a free cash flow dividend payout ratio of 12.3%. Using free cash flow, our conclusion is the same as when we used earnings to measure Roper Technologies' dividend safety. The company's dividend appears very safe for the foreseeable future. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Roper Technologies' current dividend safety in the context of the company's historical recession performance. We believe the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Roper Technologies' performance during this time period is shown here. Roper Technologies' earnings per share declined by 16% peak to trough during the last recession, which shows that earnings remained relatively stable. More importantly, the company's earnings continued to cover its dividend, and it continued its multi-decade streak of consecutive dividend increases. Accordingly, we have no concerns about the company's ability to pay rising dividends during future economic downturns. The last angle that we will use to assess Roper Technologies' current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before the company's free cash flow will no longer cover its dividend payment. During fiscal 2018, Roper Technologies generated $182 million of interest expense and had $4.9 billion of debt outstanding for a weighted average interest rate of 3.7%. The following image shows how changes to Roper Technologies' weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, Roper Technologies' weighted average interest rate would need to rise to almost 30% before its dividend would no longer be covered by free cash flows. Accordingly, we believe that Roper Technologies' debt level is very unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Roper Technologies' current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.